Hello, and thank you everyone for joining so far. I'm just going to give it one more minute before we kick off, just to allow a few more people in from the waiting room, and then we'll begin. Okay, so it's 12 on the nose, so I think probably it's now a good time to start. So welcome to today's session on the Labour budget and our first impressions. My name's Louisa Gaynor, and as hopefully many of you know, I'm a senior client advisor here at Netwealth. And I'm joined today by Jared Lyons, our chief economic strategist. And today we're going to talk through our impressions of the budget. We're going to speak about the key takeaways for our clients, as well as the impact that this has specifically on your pensions and your estate planning, and the importance of putting a robust financial plan in place from today moving forwards. But I think the first thing to do is to take it back and to think a little bit about Rachel Reeves, her announcement, the context of it. So, Jerry, if you could give us your first thoughts of the budget.
Well, this was very much a tax, spend and borrow budget. The Labour Party has inherited a moderately improving economy, but they also inherited a very poor fiscal position. Debt level was very high, and financial markets are very conscious of that. So when you have a debt problem, any government really has a choice of 5 options. You can have a choice of more than one of those. So the ideal situation is to grow the economy, or you reform public services, or you curb spending through austerity, or you tax, or you borrow. Now, the growth picture from this budget, even though the Chancellor has talked about this being a growth budget, the independent OBR is quite cautious about growth prospects. In terms of reform, there wasn't much reform in the detail, although the Chancellor did talk about squeezing budgets for the public sector by about 2%. So it came down to those other 3 areas in terms of whether you curb spending, whether you tax more, whether you borrow more. Now, she didn't curb spending, did quite the opposite. In fact, it provided, in fiscal terms, a huge fiscal boost. The difference between government spending and government revenue through taxes is an additional £208 billion over the next 5 years, which by economic standards is big. So spending has gone up. And to fund that higher spending, the Chancellor has had to raise taxes and also to increase borrowing. So spending is not only up significantly, but we now have taxes going up by on average or just shy of £40 billion a year over each of the next sort of 5 years or so. And borrowing, which was already high, is now going up by, roughly speaking, £30 billion a year more. So when one looks at the picture, it's very much increased spending, and that has to be funded, and it's going to be funded by higher taxation and higher borrowing. So a tax, spend and borrow budget.
And really with that, it was also quite interesting. Not only was she the first female chancellor to make this announcement and to give a budget, which in itself is quite unbelievable, but she also began her speech by giving some historic context. And so can you just shed a bit more light on that?
Yeah, well, you're quite right. Actually, she began by talking about the years 1945, 1964 and 1997. And in each of those years, Labour had won power from the Conservatives. 45, obviously, after the war. 64 was Harold Wilson and the white heater technology was his big focus. 1997 was Tony Blair. She didn't actually mention one other year when Labour also won power from the Conservatives, and that was 1974. And in my opinion, 1974, even though she didn't mention it, is probably more relevant in terms of historical comparison. That's because the 70s was such a difficult economic environment, both in the UK and globally. Now, then the focus was very much on inflation. Now the worry is more about growth and debt. Obviously, in the mid-70s, the UK government had to go to the International Monetary Fund, the IMF, to borrow. That's not going to happen now. But debt is really very much centre stage. So that historical comparison is very important. Obviously, since yesterday, people have started to talk about this being the highest tax increasing budget since Norman Lamont in 1993. Now, has to be said, whoever is in power, the first budget after an election tends to be when the bad news is doled out. If you have to raise taxes, that's when you do it. People have just voted you in, and you hope by the time they come to vote again, they would have forgiven you or said it was the right thing to do. But when Lamont, as Chancellor, raised taxes significantly then, he had lower interest rates and a weaker pound alongside that. And so the economy actually did incredibly well. This time around, interest rates, whilst they are falling, are not likely to fall aggressively. The pound is relatively stable, but to offset the tax increases, it's very much the spending increases this time that the Chancellor hopes will grow the economy. But as we saw from the detail from the OBR, the official forecaster, there will be a sort of growth hit, a boost in the next 2 years or so, almost a sugar rush. But what was noteworthy was that they were cautious about growth 4, 5, 6 years out. So the comparison, I think, is 74, because it's really very difficult UK and global context, and also 93 with Lamont, because it was a tax raising budget then as well.
Yeah, no, it's very interesting and thinking about it in the context of history and what that may indicate we might see going forwards. And so what would you say, picking out from that, were the good bits of the budget?
Well, the real good bit was the focus on investment. The UK has historically had low investment. To show how much older I am than you, I wrote about this in the Times in 1991, and it caused a stir. I do remember at the time. I was quite pleased about it. I pointed out that UK investment, public investment, and R&D, research and development investment, had been very low in the 60s and 70s and the 80s compared to our international competitors. So it's remarkable that half a century later, this is still an issue. So the Chancellor, I think, was right to talk about the need to boost investment. So I took positively the fact that public investment is going to be boosted. It's going to help the green agenda, it's going to help the supply side of the economy, and it's going to address infrastructure shortfalls. The challenge for the Chancellor, indeed for Labour, indeed for all of us maybe, is that the benefits of that take some time to feed through. Also, we know the government is not always good at choosing investment projects. And if one just looks at HS2, which is the biggest infrastructure spend in Western Europe, that can soon, in cost terms, overrun. So we need to be mindful of that. And also in an economy like Britain, actually, often the best way a government can make inroads is by keeping the current stock of things going. And that's current consumption, that's not investment. But nonetheless, the investment component was really a positive, even though it adds to borrowing near term and it will take time to feed through positively. So the investment is good. Obviously, what one hopes is that to get investment up, you need to have the private sector willing to invest. And you need the city, the financial sector, to step up, because we have big financing gaps in Britain. Patient capital is absent. And also, there's not enough lending to small firms. But the real positive was the focus on public investment. And let's hope it does actually materialise as she outlined.
And in the right way, I suppose.
And in the right way,
And then, not that we want to touch too much on the negative, but what would you say was the bad bit about the budget?
Well, the tax increases. You can't tax your way to growth. Obviously, if you look at it from the debt perspective, something has to add up. And if you spend more, you have to tax more and you have to borrow more. Ideally, you grow your way out of this, but that's not where we are at the moment. But the bad news was the big increase in taxes. Now, obviously, Labour committed to not raising taxes on working people, as we know, in the manifesto. The question, of course, politically is whether they have a mandate to raise taxes, because they didn't really talk about it, and whether they've broken the spirit of the manifesto commitment. But in economic terms, is what impact will these higher taxes have on the economy? And the biggest increase is in national insurance. Now, employers, that's right, not for workers. So it's a employers tax. Now, that raises £25 billion initially, but the OBR in the 5-year projection points to a third of that being passed on by the end of 5 years in terms of the government raising less taxes. So what happens with higher national insurance for employers is that the employer pays it initially, but then they start to pass it on to their workers. They recruit less people, hence it's called the jobs tax.
And an issue with salary rises as well.
Squeezing down on salaries and bonuses, and profit margins might be squeezed, or they might pass it on in high prices. So at the end of the day, we as consumers or workers pay the price, we
Yeah.
collectively. So that is also a problem in terms of many small companies up against sort of tight budgets. Now, if you're 0 to 4 workers in your firm, you get some relief.
Yeah.
But it was not just the increase in national insurance, it was the threshold at which it applies
Yes.
was reduced. Also, minimum wage increase. Now, I used to be at City Hall, I worked for a while. I was the ambassador for the London living wage. So I've always been keen about pushing up living wages. The challenge, though, now is when minimum wage has risen so much, and as we saw yesterday, it's now rising by over 6% in line with the cost of living crisis. That starts to really put pressure at the lower end on many small firms because they have a sort of salary structure, and not only are they having to pay the higher cost of those workers, they might have to pass it on. So the real challenge is how this increase in taxation and associated costs works its way through. And in the forecast accompanying the budget, it's quite clear that the official forecaster thinks that over the next few years, there will be a boost to growth, but 3-4 years ahead, it's not going to be particularly good. In fact, if I could quote some figures, the real worrying figure was household disposable income. So the forecaster expects this to go up in real terms by 2.4% this year, then 2.1% next year. But the following year, which is 2026, only up 0.6%, and then only 0.2% the year after. So the point is that wages are not rising much. Those tax increases are biting, and also inflation is now expected by the OBR, and they could be wrong, of course. They now expect inflation to be slightly higher in the future by 0.5% more than they previously expected, which adds to, if it is true, it adds to costs in terms of interest payments, and it might make the Bank of England less keen to cut rates.
Yeah, I mean, it's certainly it's a very interesting debate, and finding that balance is obviously something they've struggled to do and hopefully have managed to, but I guess we will see. And then just kind of finally, before we move on to the specific takeaways for clients, is there anything else you think we should address kind of here and now? For example, the Bank of England, how they've reacted, things like that?
Yeah, well, UK interest rates are 5% at the moment. Ahead of the budget, the market was expecting UK rates to keep heading down over next year, sail through 4%, maybe even hover down towards somewhere between 3.5%, 3.75%. The markets are now more cautious after this, partly because growth is expected to be stronger in the next couple of years. There's a huge fiscal boost, and often when there's a huge fiscal boost, it makes the Bank of England think twice about cutting interest rates. And inflation, according to the OBR, is expected to be more stubborn. Now, the Bank of England, of course, has their own forecast. Unfortunately, their forecasts haven't been particularly good in recent years. So the bank next week cuts or meets. I think they will cut next week. If they were to not cut next week, that might be interpreted politically as a sort of downer on the budget. And I don't think the bank wants to be in that situation, but they should play it with a straight bat, to use a cricket analogy. I think the economic data at the moment justifies a rate cut. But I think the net out of all this is that interest rates probably settle at a higher level than people previously expected, around 4% or slow. So that's really the issue. And in terms of individuals, and you're about to go through the planning horizon, obviously there's been a rush for some people in the last few months. This is, in some respects, been a wake-up call, but the worry is there might be more of this to come. We have a comprehensive spending review next year. Now, that's in the back of the Chancellor's thinking. That will add, in my mind, to upper pressure on spending. So taxes could yet go higher. And then the further ahead one projects, if growth disappoints, or if inflation does prove stubborn and interest rates don't fall as much, then there's going to be greater pressure on the public finances. And unfortunately, some of the issues we've talked about in the last 24, 48 hours, indeed, last few weeks, will come more to the fore again. So it's a time to be thinking long and hard about your personal finances.
Yes, I think it's really just the key is to get them onto the review, to feel as though you're in control of them now with the
Yeah,
rules as we know them and what we know them to be,
yes,
and that those that are going to come in. But actually, they are subject to review and they are subject to change. So
yes,
just having a good understanding of how you're split
yeah,
and a plan in place for now is helpful,
yeah,
and one that you can evolve with time. I
absolutely.
suppose is what you're saying there.
Yes, yes.
Yeah.
Let's hope it gets better,
Yes,
but
let's hope let's
sometimes prepare for the worst. But
yeah, exactly. But let's hope it gets better. But thank you very much for that, Joe.
yeah,
That's
pleasure.
really helpful in terms of kind of getting an overview of your key takeaways and thoughts on the budget. And I just want to go a little bit more specific now around how this really impacts our clients or what we think are the key things to raise. So you've mentioned about employers' national insurance contributions. Those are perhaps less relevant for our clients. The things that I think are particularly relevant for our clients, we can see on this slide here. So the first thing that I wanted to highlight is around stealth taxes. So no changes were made to income tax rates or income tax thresholds and allowances. They actually remain frozen until April 2028. So this date wasn't extended, which it could well have been, but it does mean that that fiscal drag continues. So as wages increase, as income increases, it will push more people into those higher tax brackets over time. So these are due to increase again with inflation in 2028, but that still leaves us 4 years in which
Mm,
more people are being pushed into those higher tax rates. So it's certainly something to think about there. The state pension is, and the triple lock is an example of this. As I'm sure you know,
mm,
that they've chosen to increase with the triple lock, which means that it's quite a generous amount of a guaranteed income that pensioners are due to receive each year, and more of that is soon to be pushed, above the personal allowance into the basic rate band, because it will be going above £12,000 per annum quite soon.
yes, that's right.
And so I think really actually the other things that I wanted to focus on today are talking more about the changes to inheritance tax, to pensions, which actually remain mostly unchanged, but I'll come on to that in a bit more detail in a moment. I thought it important to address capital gains tax, which I know affects a lot of our clients and which we looked to kind of utilise ahead of this announcement as well. And also a key point that we've been discussing a lot is the introduction of VAT on private school fees, which is due to come into effect from January 2025. So if we start with inheritance tax, the first thing we know is that the nil rate ban and the resident nil rate ban are frozen. So that's at £325,000 and £175,000 respectively. And that date was supposed to be until the 5th of April 2028, but the Chancellor has actually extended that, so they're now frozen until the 5th of April 2030, which is quite a significant amount of time. Then beyond that, another key area that was addressed was agricultural and business property relief, as well as the relief that applies to AIM shares. So the government have chosen to reform agricultural and business property relief. This will take place from April 2026. And the changes mean that above your nil rate band and your IHT exemptions, the current 100% rate of relief that applies to agricultural and business property relief will continue, but only for the first £1 million of combined agricultural and business property. With anything above that, a rate of relief at 50% will be applied. So it makes quite a significant difference for those that this is applicable to. So I would really suggest, if you think it does affect your circumstances, getting in touch with us. We can discuss it with you on a one-to-one basis and adjust your plans accordingly or whatever may be relevant. One good thing to come out of the budget, which I think it is important to highlight, was that the potentially exempt transfers or PETs and the 7-year rule remains unchanged. This was quite a well vocalised concern in the lead up to the budget. So the Chancellor thought, or we thought, she may extend the 7-year rule to incorporate it to 10 or even 14 years, or even put a cap on the amount that could be transferred as a potentially exempt transfer. And actually, none of these things have come into play. As we've already said, it is a moving feast, it's under
Yeah.
review, it may change, but as of now, these things still exist. And so it's a really important planning point, thinking about gifting, when to gift, the value of gifting earlier, and just understanding how much you're able to gift and still live comfortably. All things that we can discuss with you, and all things that it's really important that you think about. And then finally here, an important point, and one that does affect many of our clients, is the rules around pensions and inheritance tax. So the government is going to bring pensions within the scope of IHT, and that's going to come into effect from the 6th of April 2027. The nil rate ban will be split proportionally between pension and non-pension assets when calculating the IHT due on death. And I'm going to come on to a worked example of that in a bit more detail in a moment, because I think it is quite an important point for our clients. But what I just want to highlight now is really how, with these changes to inheritance tax, planning has become even more important, and planning when to gift has become specifically important. Doing so sooner rather than later, and making its considerations a really integral part of your overall financial plans and on an ongoing basis, can really have a positive impact on you and your family's future. So what we've got on this sliding scale here is the trade-off in gifting between tax efficiency and control. And by gifting, I mean actually passing on wealth. And you can see the gifting element of that on the left-hand side of this sliding scale. So that is by far the most tax efficient way to pass on gifts. It's the least complicated. It doesn't incur an IHT charge if it's a potentially exempt transfer, if it's a gift out of your excess income, or if it's using up your £3,000 annual exemption, which can be carried forward 1 year as well. Now, we did used to have pensions in the middle there. That used to be quite an efficient way of passing on your wealth. Obviously, from 2027, this is no longer. So it's really important to get in touch with your advisor to discuss how and if that impacts your plans, your withdrawal strategies, and what you should be doing to put yourself in a best position to pass your wealth on to the next generation. And obviously, there are still things to consider, which are seen on the right-hand side of this chart here. They allow you to exercise more control over how you pass on your wealth, but they often can be more complicated. They can involve more ongoing admin, and they can involve more of a family setup. So those are things like discounted loan trusts, family investment companies, and discretionary trusts. So all things that are worth considering. And I think the key point here now is just thinking about putting that plan in place, thinking about how you're going to pass on wealth to the next generation. And just now looking at pensions more specifically. So we were concerned a number of areas were going to change. So let's first highlight what didn't change and what still remains advantageous to our clients. So the LTA, that was not reinstated, which is great. There's no punitive tax charge to the size at which your pension grows. You're still entitled to take 25% of tax-free cash from your pension. So that's 25% up to your historic LTA. So those that had the prevailing LTA, that would be taking up to £268,275 as tax-free cash from your pension. So still a really powerful way of either using that money yourself or using it to then gift on to your children and reducing the value of your estate. Another great thing that we can look at in the accumulation phase of our life is that tax relief that we're still able to benefit from on contributions. So that's income tax benefits for basic rate taxpayers of 20%, higher rate at 40%, and for additional rate taxpayers at 45%. It's a great way of getting money into your pension, which then, as you can see from the point below, is able to grow tax-free. So all income and capital gains within your pension assets are still sheltered from tax, which is obviously a great thing, and compounded over time can make a really significant difference. So it still remains a really important planning point for all of our clients when it comes to reviewing their financial plans. So what actually has changed? And we can see that here on the right-hand side. Actually, the only major thing under the announcement that has changed is pensions now being part of your estate from an IHT perspective. And so what does that mean for you? And I thought really the best way to show this would be through a worked example. So here we're looking at an individual called Amir, and he's 80 years old when he passes away. His pension is valued at £400,000. And the remainder of his estate is valued at £1 million. So Amir has an expression of wish in place. This nominates his grandchildren as his beneficiaries. So his grandchildren can therefore either choose to take the pension when they inherit it as a lump sum payment or as income in tranches. And this will be after the IHT liability that they'll also need to settle if they're inheriting it after April 2027. So let's think about it first in the next 2 years, so under the current rules and until April 2027, which we can see in that top table on the right-hand side there. So because Emir's pension fund does not form part of his estate for inheritance tax purposes, actually what does form part of his estate is that £1 million, less his nil rate band, which gives him a taxable IHT estate of £675,000. And IHT is levied at 40%, which gives an IHT bill of £270,000 that needs to be settled by the executors of his estate. So what's the position going to be from April 2027? So from April 2027, Amir's pension is going to form part of his IHT estate. So the total value of his IHT estate increases to £1.4 million, which means that his taxable estate is now £1,750,000. So this is quite a significant increase then on his IHT liability. It went from £270,000 to £430,000. Now his executors will be responsible for paying 71% of that from his non-pension assets, because his non-pension assets make up 71% of the total value of his estate. So that is the liability due from them. And from the pension assets, they'll be due to pay the balance, which works out at just over £122,000. And that will be deducted directly from the pension assets, which then mean the grandchildren have a total value of just over £277,000 left within the pension assets, which they can leave there to grow tax-free. That position hasn't changed. And when they withdraw on it, as Amir is over the age of 75, they'll be subject to income tax at their marginal rate on those withdrawals. So if he had died before the age of 75, they would still be able to withdraw from the pension tax-free. So that advantage still remains, but it becomes slightly more punitive after the age of 75, because not only have they paid IHT on the death, but they're also then paying income tax at their marginal rate on the withdrawal. So you can see there is quite a difference here. Certainly some planning to be done in the next 2 years, and then onwards thinking about withdrawal strategies, the positioning of your overall asset base, the reliance on your pension. And these are all things we can discuss with you, and we would strongly suggest talking about them now and on an ongoing basis going forwards. And then just briefly, before I go back to some of the planning points we can think about, and also some of the questions that have come in through the session, where I'm going to pull you back in, Joe, if that's okay. I just wanted to briefly touch on the changes to capital gains tax, because they were initially actually talking about equalising CGT rates to become in line with income tax rates. But this actually just didn't happen. So that is a positive position to be in. The lower and higher main rates of CGT have increased to 18% and 24% respectively, and that came into effect from yesterday, so from the 30th of October 2024. So this lower rate actually does increase to bring you more in line with the basic rate of income tax, but actually the higher rate, 24%, remains significantly lower than the higher and additional rate of income tax at 40 and 45%. And actually what they've done now in reality is just bring all of CGT into 2 rates. So rather than having a different rate for residential properties and for all other assets, they're now both at 18 and 28% respectively. There's been no changes to the principal private residence relief, which is great. So that means that provided you meet all the criteria, when you sell your main home, that is going to be exempt from CGT, which is a really good thing. And then the other point just to be aware of is that CGT allowances remain frozen. So you have a CGT allowance of £3,000 per year. That can't be carried forward. So it is lost if it's not used. So generally speaking, and at Netwealth, certainly we encourage clients to use their CGT allowance each year on an annually recurring basis. And that's something that we can do for you free of cost. And all advisors should really be able to offer that service. There are some other changes that are due to come into effect around other reliefs, business asset disposal relief, investors relief. Those will only probably impact a few of our clients, but if they do, again, we can certainly discuss them in the one-to-one follow-up sessions. So I would strongly suggest booking into some of those. And then a couple of other points that I just wanted to highlight. Again, they're not so impactful on all of our clients, but they're certainly worth being aware of. The first is stamp duty land tax. So they have increased a surcharge for second properties from 3% to 5%, and that comes into effect from today, so from the 31st of October. Unsurprisingly as well, the previously announced imposition of VAT on private school fees, that remains, and that will come into play from January 2025. And then interestingly, but also as expected, the UK's non-domicile tax regime will be abolished, and that's coming into play from April 2025. And that's going to be replaced by a new temporary residence regime. So there are going to be some winners and losers from those changes. Those arriving in the UK will have a good opportunity to benefit. And obviously those that are currently non-dom living in the UK, perhaps with offshore trusts or non-UK properties, will be significantly more likely to be subject to IHT on those things. So it's important to think about that as well. For wealthier people, they want to think carefully about their residence position in light of these changes and their estate becoming subject to IHT, and certainly some planning points to be had around here. So something worth discussing with your advisor as well. The government has also mentioned a corporation tax roadmap. Currently, corporation tax rates are due to remain at 25%, but it has outlined, and as Jerry's already alluded to, that is going to be reviewed, explored further. So it could be a potential area where they look to increase it in the future. And finally, I think it's important to note as well that, as has been the case for many years, the Chancellor really did emphasise in her speech that this is an opportunity to raise significant amounts of tax through tackling tax avoidance and non-compliance. So she's going to introduce further measures to clamp down on umbrella companies and promoters of tax avoidance schemes. And there will also be investment into HMRC to improve systems, increase efficiencies, and tackle late payments and non-compliance. That was proposed. We'll see how it works out in reality, and that's something that really only time will tell with that. And just finally to touch on, I wanted to highlight briefly some of the important financial planning points, because that's really what affects our clients on a day-to-day basis. So one of the most key takeaways here is that having a financial plan remains key. Optimising the elements of our plan that we can control will make a significant difference. So that's things like minimising fees, consistently utilising our tax wrappers and allowances each year. Having a robust investment framework for the long term in place will really help us achieve our goals and help us to stay on track with our plans on an ongoing basis. And it will also put us in the best position to manoeuvre around any changes that may be implemented going forward, as Jerry's alluded to, they might be. Some of the key things here: ISA allowances. It remains a great way to shelter tax from assets. Or to shelter assets from tax, I should say. So making use of your family allowances each year is really a no-brainer. The same remains true from pensions. It's still a great long-term planning point. Those in the growth phase of their life should continue to think about contributing to their pensions and getting that income tax on the way in. And those who are in or near retirement should think about reviewing their plans, their withdrawal strategies, and would really look at doing so before the changes that are due to come in from April 2027 around bringing your pension into your IHT estate. And then the final one here is again about inheritance tax. Just knowing where you stand today and in the future going forward. So speaking to an advisor to understand that, to make sure you're putting yourself in a best position for now and for your family's future. So all really important points. And then this is just quite a nice graphic, I think, here to highlight the importance of minimising fees. So what we're looking at here is just to emphasise that as one of the controllables that I mentioned of fee saving over time, it can have a big difference on your overall financial plans. So what we're looking at here is if you started with a £1 million investment, over a 20-year period, you are making year on year a 1% saving in fees. That would actually correlate over that period of time to a saving of over £380,000. So a really big difference for you and your family's wealth. So certainly something to keep mindful of from today throughout your plans going forwards and in your futures. And then in terms of actually taking advice, we've covered a lot of these areas here, or at least alluded to them. Things that you want to be thinking about, so income analysis, cash flow modelling in terms of understanding what you can afford to gift. And to that point there, estate planning, investing for your children, your drawdown strategy with regards to your pension. Now those rules are going to change. Your retirement planning, they're all really important areas that can all be included in the scope of work with advice that Netwealth and any other advisor should be able to offer you. So we'd really encourage in the one-to-one follow-up sessions, just sitting down and talking through those with your advisors. And so really just to summarise, before I move on to some of the questions, because I'm conscious that quite a few have come in during this time, which is great to see. We've had some engagement there. It's a big budget, obviously. There are huge amounts of changes. We've had tax increases. We've had, as Jerry said, the thoughts on borrowing rules, setting out an ambitious investment agenda going forwards, and a huge growth plan as well. So the test will be also, as you alluded to, is how wisely they can spend this money and how they can achieve those goals of economic growth and how that actually transpires with the sugar hit, first of all, as you alluded to, and then what happens later on. So just before we go on to the questions, I want to reiterate, if you want to talk about any of this with us, please do book into the one-to-one follow-up sessions. A link to those will be circulated again after this and with the recording of this session. And we can certainly talk through the budget and how it impacts your plans in more detail. But Jerry, if I just bring you back in, if that's okay, just to touch on some of the questions that have actually come through during this session. So the first one that I would like to address to you would be, an interesting one. Is the UK economy worth investing in any longer?
Well, the answer is yes.
Yes, okay, good.
Another way of asking that question is, has this budget added a risk premium to investing in the UK? UK assets, I think, have been undervalued when one looks at, for instance, equity market performance. That's been an issue for some time. UK pension funds and others have underinvested in UK equities compared to the past. And that's partly legacy issues about changes to defined benefit scheme. The market reaction to this budget has been interesting so far. There was an increase in 10-year gilt yields immediately after, and then they stabilised. They went from 4.25% to 4.40%. The pound is relatively stable, equity market relatively stable. They have to be seen in the global context. But UK people are mindful of high debt in the UK and weak growth. The challenge really is a Western European one. Germany, France, Italy, the three big economies on the continent, are all pretty much in the doldrums. So I think it would be unfair to penalise the UK versus the continental economies. But you need to have a reason to invest in the UK. I don't think this really makes people sort of want to run to invest in the UK, and that's the challenge. It doesn't imply a higher risk premium, I don't think, but it's a budget that sort of lands somewhere in the middle. Partly because of all the issues we touched about earlier.
And actually after much review and consultation, they chose to get rid of that British ISA, didn't they, that the previous government had proposed.
One thing this government did, compared to, people think about the mini budget a couple of years ago, obviously that was a very different environment. Then the markets were obsessed with inflation. Markets are now going through an evolution away from a focus on inflation to a focus on growth. And I think in the future, it will be a focus on debt. So in some respects, the markets are trying to come to terms with the growth implications of this budget and the extent to which interest rates can still fall. But delivering on the growth is key to delivering that UK sort of attraction.
No, it's a very good point, and something that we'll just have to watch what happens. And I've seen another question has come here saying, are pensions still able to be passed on to married spouses tax-free? And that's a really good point to raise. So the spousal exemption for IHT purposes does still exist, and there have been no mentions of changing that. So it is certainly worth thinking, actually, from a planning perspective, about what your expression of wish says, because you may want to change that to passing directly to your spouse if it doesn't already do so, rather than previously what you may have done is thought it should pass directly to your children or other beneficiaries. It's something worth thinking about, because that exemption there does still come into play. So it's a very good question to ask, and a very good planning point there. I can see something else that has come in for you, Jerry. What one big policy that was not announced would you like to have seen in the budget, and why?
Oh my goodness, that's really. I would like to have seen. Look, the way the question is framed is part of the problem. There were 70 tax and spending measures in this budget. When one looks at the last 4 Hunt fiscal statements, autumn statements and budgets, they weren't far off in having almost sort of 60 to 70 on average in each. The tax code in the UK has become complex. What I personally would like to have seen is simplification. I would like to have seen, in terms of income tax, marginal tax rates clarified, because when you have your child benefit taken away, your marginal tax rate goes up. When you go above £100,000, if you're lucky enough to be earning that, you then go above to a really high marginal tax rate. What I would like to have seen was the removal of what used to be called in the Treasury the Manhattan skyline, because you look at marginal tax rates and they go up, down, up, down, up, down. I would like to have seen that simplification of the tax system, more so than the rate to tax, is the immediate issue facing, in my mind, many people and many companies.
Very good. Hopefully they will factor that in. And
I'll be keen to give my advice.
I'm sure you would do well at that, and they would benefit from it. And just slightly circling back to another planning point here, I've had a question come in saying, does the 25% of tax-free cash from your pension, does that count as income in the year you receive it? And so could it be gifted as excess income to your grandchildren? The answer to that is, whilst it is tax-free cash, it's not considered income. It's considered a capital receipt. And so were you to gift it to your grandchildren, in an outright gift, it would be considered a potentially exempt transfer. But were you to invest it in a, for example, general investment account in your own name that generated its own source of income to you, and then you regularly gifted smaller amounts of that, that could certainly be seen as gifts out of excess income. So another really interesting planning point there, and certainly something to think about within your plans, and something that we'd be happy to talk to you about as well. So let's just have a look at some more of these questions. Okay, so we've had
maybe one last one.
Okay, fine. Yeah, that's a very good point. Getting carried away here. So
I've never seen anyone get so excited about the tax details as you. It's really interesting to see.
It's an interesting side. We don't like to dig too much into it.
We need to get out more.
Yeah, a little bit. Okay, so how likely is it that a revenue raising measure outlined will achieve the £40 billion per annum identified shortfall?
All right. Well, the shortfall is an interesting one, because that is the so-called black hole. A strange name to term it, but a fiscal gap. There's lots of political controversy about that, but that hole has been swallowed up, shall we say, in terms of the numbers, and has been superseded by additional measures announced yesterday. But the underpinning of the question is that, do all these tax changes really truly deliver? And we've already seen, in terms of the national insurance increase, which is the biggest component, that is likely to not claw in as much revenue in the future because of behaviours. And the key thing is, maybe the takeaway is that incentives matter. Incentives matter not just for individuals, but for companies. If you want to incentivize people to spend, then you need to give them a reason to do so. And if you start to have higher taxes, then you start to encourage behaviours that you might not otherwise want. In an ideal tax system, taxes should be neutral. They should impact how people react. But just the last 40 minutes or so shows that clearly tax changes do naturally cause people to change their behaviour or to think about how they plan in the future.
Yeah, absolutely. Okay, well, I think that's probably all we have time for today. I have seen that a lot more questions have come in, and I'm sorry that we're not able to get to them now, but it's a great reason to book in for the one-to-one follow-ups where we can absolutely address them and also talk about the wider planning. But for now, thank you.
I was going to say, I've written something on the Our Views
Yes.
page about the budget if people wanted to have a read as well.
Yeah, absolutely. So I definitely recommend going to that, which you can find via our website, as a really good overview of everything Jerry's covered today. But for now, Jerry, thank you very much
Pleasure.
for your time. Appreciate your expertise, and yeah, look forward to hearing more commentary from you going forwards. And for everyone that joined today, thank you also for your time, and we'll look forward to seeing as many of you as possible in the one-to-one follow-ups. So thank you and goodbye.
Goodbye.